Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 5450 as I'm speaking, which is an all-time high for that index. It is up about 15% year to date, which is incredibly strong performance through the first of the year. And really been driven by what I'll call a little bit of a Goldilocks moment for the market. Those of you who have seen me speak before earlier this year would sort of know the sort of story on inflation, disinflation, everything that's been going on with the CPI. The first quarter of this year, we received a lot of data that would suggest that inflation wasn't really cooling off. And then late last week, we got the inflation print for May, which actually showed a 0.16 reading in the core, or 0.2% month over month in the core, which was A, below expectations, but B, at the level at which the Fed would consider, modestly acceptable in terms of overall inflation rate. So you take 0.2% or just slightly below it, and you multiply by 12, and you get a number that the Fed, or at least most people would think that the Fed would find acceptable for an inflation rate. And there has been much rejoicing in the market. We talked a little bit about Goldilocks. Goldilocks' proverbial problem is always, is it too cold, is it too hot, or is it just right? The Fed dealing with the same scenario, right? If inflation is too hot, if prices are going up too fast, then I have to raise interest rates. Maybe I haven't done enough to cool off the economy, and that's a problem because the markets don't like it when interest rates go up. If the economy's too cold, then that might mean that we have a demand problem and that companies are going to start to report, bad earnings because we don't get the economic growth that we'd like. We get that scary sort of recession word in the event that the porridge is ice cold. That's what the Fed is also trying to avoid. So we're really trying to stay in the center. And that's exactly kind of the print that we got last week, which is, okay, things are cool, but if I look around, unemployment's still pretty good and everything else around the economy looks pretty okay. We also got a consumer confidence number late last week, which was a little lower than what we'd like, the lowest since November of 23. That's not necessarily the worst thing in the world as consumers slow down spending when they don't feel as confident. That can also help with the inflation picture as well. So really right now we're right in that center where the cereal's just warm enough. We're seeing demand. We're seeing companies continue to grow and report good earnings, but we're also seeing some moderation on the inflation side. And I think most market participants would expect to see some acknowledgement of that out of the Fed in their minutes for their next meeting. However, probably looking to see a couple more months of lower than expected readings, or at least lower readings, not necessarily lower than expected, before we would see them start to think about a cut. And really, the data that I've seen would suggest that, the earliest we should really be thinking about a cut is kind of September, and that kind of assumes that all of the data that we get between now and September continues to be in this sort of moderation of inflation point. We want probably 2, 3, maybe even 4 data points of this sort of lower than or acceptable inflation level before I think the Fed's going to feel comfortable starting to take their foot off the brake. So with that, as always, if you have any questions, please feel free to reach out to me or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.